All right, I think we're ready to start. I want to welcome everybody back from that last interesting discussion and a short break. Our next paper is, as you can see, Congruent Financial Regulation by Andrew Metrick and Daniel Tarullo. And I think Andrew will start the presentation.
Thanks a lot, Jan, and thanks to Jan and Jim for inviting us to this and to Brookings for hosting it. I'll dive right in. We're going to hold ourselves to just 5 slides of content here. I'll do the first 3 and Dan will do the last 2. First, talk a little bit about the general problem, which I think won't be a surprise to anybody listening. And then quickly about 2 case studies of malfunction, of the type of malfunction that we think we would like to see the regulatory system attempt to fix. And then Dan will talk about what our fix is in general, and then specifically how one might implement it in, for example, these 2 case studies. So that's the plan. Okay, so first, the statement of the problem. We made banks safer. I think it's really quite good news, and we shouldn't lose sight of this good news, which is that not only did we have a massive liquidity panic a year ago, but we have had a year of much worse economic performance for very good reasons than I think was in any of our stress test models. But yet we're not hearing about bank solvency concerns. Nobody is saying, oh, I'm worried about this bank, we're going to have to bail out this bank. It's just not a common conversation, at least right now in the developed world. And that's really outstanding. That would not have been the case, I think, pre-GFC reforms. But also, we have to recognize that buying that safety, does cost something. And while we have shored up bank balance sheets tremendously, and that's why they were able to absorb this shock, there are constraints now on those balance sheets, and those constraints have been filtering through the system over the last 10 years, such that what we used to call the shadow banking system, and now goes by other names, non-bank financial institutions is the popular one now coming out of the FSB. But basically, if you're doing a traditional banking function, but you are not a bank, you are not a depository, you're not subject to all the same rules as banks, we're seeing that part of the system, that parallel system, really grow in its market share across a lot of different markets and do some things that it hadn't done before. And even people who consider themselves experts on the system, as I used to until I learned how little I knew in seeing what had gone on in the last year, are surprised by some of the changes that have happened in the last 10 years, partly as a result of, we can call it regulatory arbitrage, or just the movement of the activity away from the place where it might have some regulatory costs to places where it does not. Now, even though the shadow banking system, if I'm still allowed to call it that, is less regulated than banks, it's still the case that in extremis, it does benefit from the safety net and contribute to systemic risk. So we have observed that. And when the Fed did its monstrous work and the ECB did its monstrous work a year ago, among the beneficiaries were some of these non-bank financial institutions that had been engaging effectively in bank-like activities, but without all of the regulation. So maybe this is what we want. I don't think it's what we want. Dan and I don't think that this is really that we got here in any kind of planned way, but rather we've kind of gotten here because we made one part of the system safer and people kind of took their cars on a different highway that wasn't subject to the rules. And so this is a good opportunity for us to step back and think about what we want to do. Okay, so quickly, non-prime mortgages is one of our 2 examples. The other is what happened in Treasury securities. So non-prime mortgages, we all know that this was a big issue leading into the global financial crisis. The private label securitization chain, we all learned about that, asset-backed commercial paper, securitization, CDOs. We had an alphabet soup before the global financial crisis. Largely, a big chunk of that market went away. And there's very little private label securitization for non-prime, non-Fannie and Freddie loans these days. We're not really seeing anything there. So, but people are still getting these loans. Largely, they are in the United States guaranteed by the FHA or the VA. The VA actually having a larger market share now, so somewhat surprising. And they get securitized, are guaranteed by the FHA and the VA, and they're securitized by Ginnie Mae. And who's ultimately buying a lot of these things, even the agency guaranteed stuff, a lot of them are being bought by mortgage REITs, mortgage real estate investment trusts. And all along this new chain, kind of at every step of the chain, from the individual mortgage brokers that are arranging the loans, the non-banks that are arranging the loans, and they have 75% of this market, all the way down to those who end up owning it, are a bunch of institutions often serving the same role that banks used to. You know, they're originating and then holding on to these loans, but subject to very different regulation. So the paper has some figures that show these nice little chains and describe each one of the things in it, but it would be hopeless for me to try to do that in my time available. So I'll just point people towards the paper. Figure 4 has what I just described. You can see, however, in figure 8 of the paper that, in fact, even these mortgage REITs, which are holding guaranteed, government guaranteed securities, these things have no risk any more than the dollars in your pockets do. They fell in value by 80% in March. You know, that is clearly a liquidity effect. They're highly levered. Markets start to disappear on us. And so there's no question they were helped tremendously by the Fed's infusion of liquidity, but we don't get to tell them how much leverage to have. So we don't have the same rules as we do for banks. Treasury securities, they've gotten a lot of attention. You know, we know these markets we first noticed these markets could malfunction in ways that we didn't quite understand in September of 2019. We saw that again in March of 2020. It's led to a lot of papers on this topic. Many people who I'm sure here in this audience who know much more about it than I do at the level of detail. Dan and I aren't trying to come and claim somehow we have some special insight into this market specifically. Rather, we just want to talk a bit about how it got to where it did and how we might want to fix it and change and fix it in a more general way. So instead of the world of primary dealers buying this stuff and then intermediating them, as I think is now well known, it's a world where hedge funds are selling treasury futures. They then buy the physical treasuries and hold them until they deliver them for the futures contract. And while they're financing that whole thing with repo. And ultimately, the other end of that repo often is the money market mutual funds. So banks are somewhat out of this business, in part because of the regulatory balance sheet cost. And it's been taken over by this interesting chain of money market mutual funds, hedge funds, and now in the most recent years, central clearinghouses. So FICC, the Fixed Income Clearing Corporation, in fact, has a form of repo that really enables banks to avoid balance sheet cost. Money market mutual funds had no money in this as of 2017. On the eve of the crisis, they had $250 billion. Okay, so this was really quite a surprise. This is a form of sponsored repo, which just hasn't gotten a lot of attention. And so why, again, we're going away from our nice, safe banks this other way, and we learned that this system could be under great stress. So how do we fix this? So I get to just state the problem, and now I can leave it completely to my co-author for the solution. Take it away, Dan.
Okay, thank you, Andrew. So in light of the continuing permutations of NBFI activity of the sort Andrew's just described and which we go through in the paper, we suggest an organizing principle of congruence to guide regulatory initiatives. So let me say a few words on what we mean by congruence, and then I'll provide a very brief illustration of a first, although we think significant step for implementing it. Our core notion of congruence, of our congruence principle, is that forms of financial intermediation posing similar risks to financial stability should be regulated with similar stringency. And that should be the case regardless of the legal form or the business model of the entity involved. As we conceive it, the congruence principle has the following key attributes. First, the resulting regulation should be directed toward containing systemic risk, not all the risks that are associated with, for example, bank regulation. Second, while we contemplate that only significant contributions to systemic risk would be covered and thus regulated, Congruent regulation, in our mind, would aim for ex-ante comprehensive coverage of activities that pose similar risks. And that would be a distinction to the present situation, in which, since the global financial crisis, we've had a largely reactive business model by business model approach to trying to regulate MBFI activities. And obviously, this is aspirational. This is not something that could be achieved right away. Third, congruence does not necessarily mean identical. So, for example, in our suggested approach to regulating lending collateralized with securities, we contemplate the use of haircuts and margins as well as capital regulation. And a corollary of this point is that we wouldn't need an overhaul of regulatory activity, such as would probably be necessary to adopt a purely activities-based approach. That is, you wouldn't need a lot of legislation to be able to start the job. Congruence can now be applied through the existing balkanized, institutionally based regulatory system. So what in the paper, next slide, Andrew. In the paper, what we do is to outline a process that could be followed under present law to achieve congruence in the regulation of the systemic risk associated with securities financing transactions. We don't actually do that work of calculating what the margins would be, at least not in this paper. We're just trying to show that it is possible under existing law. Now, to do this, there would first need to be an analytic exercise to determine the appropriate macroprudential charges associated with this activity. And then you'd need an implementation exercise to apply appropriate regulatory requirements across the various markets and platforms in which the activity takes place. In practice, the two exercises may well be melded, since the differing kinds of risks that one observes with, for example, a central clearing facility as opposed to bilateral transactions would probably be taken into account even in the analytic phase. Now, let me just say right away, this would not be a straightforward process, either substantively or procedurally, and Andrew and I recognize that since we first began thinking about it. As to substance, the regulatory agencies would need to determine, in effect, the macroprudential component of capital and potentially other bank regulatory requirements. That is to say, distinguish them from other regulatory purposes. The current capital regime obviously doesn't make a clear identification of how much of regulation is macroprudentially motivated. So this is going to call for considerable technical work and ultimately judgment. But I'm not sure that it would call for any more of that technical work or judgment than lots of current regulations, things such as swap margining requirements and indeed capital requirements themselves. And the exercise would have the virtue of focusing all the relevant regulatory agencies on system-wide risks. As to the process, we'd need to involve 5 or 6 agencies, the banking agencies, the SEC, the CFTC, and at least for Treasury-backed lending, the Treasury Department itself. Now, it's obviously going to be a challenge to get agreement among all these agencies, as we saw with the implementation of required joint rulemakings under the Dodd-Frank Act. But, and this is potentially a very important point, we do think that legal authority exists for a single agency to drive the process, both with respect to transactions involving treasuries as collateral and those involving other securities. Now, it may come as a surprise, even to people immersed in financial stability policy, that we think the Treasury Department has authority to set minimum haircuts under the little-noticed Government Securities Act of 1986. To date, the Treasury hasn't really actively used that law. It basically passes the implementation to the banking agencies and the SEC, and it's more or less incorporated SEC capital requirements for dealers. But the scope of the financial responsibility, that's a term of art, financial responsibility standards, which Treasury is asked to promulgate under that act, we believe is potentially quite broad-ranging and could cover minimum margining requirements. The Fed has parallel authority under the Securities Exchange Act of 1934 with respect to all securities financed lending transactions that are not backed by Treasury collateral. Indeed, some of you may remember that back in the 2014-15 period, the Fed was contemplating use of that authority in order to implement an agreement it negotiated internationally in the Financial Stability Board to have minimum margins on non-government securities-backed securities financing transactions. Unfortunately, that agreement has been shelved every year since. In both cases, there's not the authority to cover transactions as such, but the statutes provide, I think, enough regulatory room because basically they allow Treasury and the Fed to impose the regulations on dealers. And the definition of dealer under the Securities Exchange Act of 1934 is pretty broad. There's limited judicial precedent on it, but what precedent there is suggests that if you're doing a lot of business, you are a dealer. Now, given the structure of the two laws, the implementation and enforcement would have to largely be done by other agencies. And that means it will need to be a cooperative and thus somewhat messy enterprise, even though we do have an underlying single legal authority. But Andrew and I began our exercise almost a year ago, and we're ending it today, or at least interim ending it, by asking what's the alternative? If the alternative is just to leave each agency to its own devices, we don't think that's a very good response to what we saw in March. And if the response is to say, the alternative is to say, let's wait for Congress to comprehensively reorganize macroprudential regulatory authorities so we can do everything on a transaction by transaction basis, that may be a long wait. Thanks very much.
Thank you. Both Dan and Andrew, that was great. Their first discussant is Vera Latoria.
Thank you, Jan, for inviting me to discuss this really interesting piece by Andrew and Dan. And I wanted to start out by stating a very interesting theorem that my colleague Larry White explained to me when we were writing our book on the government-sponsored enterprises and the debacle of mortgage finance in the United States. In his sort of unique way, he called it the waterfall theorem of arbitrage in the financial sector. And the theorem was that risk travels within the financial sector until it reaches the balance sheet that has the lowest regulatory capital requirement to warehouse it. And in our book on the GSEs, we were explaining that for how GSEs ended up with such a large share of mortgages on their portfolio, because there was this capital arbitrage in the system, and the waterfall theorem meant that whatever the GSEs could hold, they should hold all of it in big chunks. And I think the piece by Andrew and Dan highlights two very interesting examples of this, especially the first one on how the non-prime mortgage originations end up in many cases, with REITs holding these assets. And more broadly, this has led to the view that gets echoed, I would say, on a recurrent basis in the literature on financial regulation, that we must regulate by function rather than form. And I think there are two variants of it. The first one is the most common one, which is that we should regulate things that look like banks as banks. But perhaps there is also an instrument version of it, which is that, we should regulate deposits and money market savings in a similar way. After all, we know through history that money market funds came about because of Reg Q, and the Reserve Primary Fund, the first to be formed and the first to fail, was really a cycle of shadow banking getting around Reg Q. And ditto for portfolio mortgages versus mortgage-backed securities, because sometimes even for the same institution, if the risk is pieced up into different alternatives, we don't have internally consistent regulatory capital requirements. And I think of Andrew and Dan's congruence principle as, I think, another take on this important point. And I think it's crucial that they have brought it back in spotlight, because there has been a tendency in financial sector regulation to forget about this once we have reacted to the last war. But what happens is, once you finish the last war and your immediate reactions to it, such as the Dodd-Frank Act, of course, the waterfall theorem starts applying all over again. And, over a decade, by then you have several imbalances showing up in different parts of the financial sector. Now, there are several reasons why I think the systemic risk focus of the piece is absolutely crucial. And besides the overall risk that the system as a whole could collapse because maybe shadow banks have just become very large, I also want to highlight that invariably shadow banks have been found to be very close to banks in their activities. And perhaps this is not surprising once you think about the waterfall theorem, because banks are by and large involved in originations, and therefore they are a part of these regulatory arbitrage chains in one way or the other. And sort of, I like this quote a lot. It's actually from a children's poem on shadows, that shadow always touches the feet. And I think there's something similar to shadow banking. And the linkages arise either through explicit guarantees. Banks provide credit lines to give credit enhancement so that money market funds can hold sort of short-term paper. They may have provided implicit guarantees to get around, some capital requirements and move stuff off balance sheet, such as in SIVs and ABCP vehicles, asset-backed commercial paper vehicles. There's also just flow of fund linkages, which is that banks may be providing insurance, liquidity insurance to firms. And then when the bond market freezes, firms are now insured by drawing down on credit lines. So even if bond market freeze is not directly connected to banks, through the chain of contracts, the fact that corporates have arranged insurance, it again comes back to the banks. And of course, there's information contagion and direct interconnectedness. So I think getting into the cracks of systemic risk into the shadow banking is important to ensure safety of payment and settlement systems, because at least as of now, banks are important parts there. We'll have to see how that changes if digital stuff takes off in a big way. And there's a second reason why I think Andrew and Dan's piece is very, very timely, especially after what we have seen in response to the COVID. I think the central bank remit has really shifted over the last 12, 13 years. I think it's almost a given. Everyone now almost asserts that we have learned that the efficient thing to do is for central banks to not just be lender of last resort to institutions such as depositories, but that they should really be a buyer or market maker of last resort for systemically important markets at large. Now, people say this very comfortably and almost as a matter of fact, but I think it has a tremendous implication if one thinks that moral hazard is something to worry about, that we have effectively expanded the safety net to essentially all parts of the financial sector. My sense is, at least as of now, one has to pause and accept that that's the state of affairs, whether we like it or not, and whether it's efficient, exposed or not. And therefore, I think it's paramount that we start thinking about whether there's adequate private insurance in contracts, because otherwise, I think the long shadow of moral hazard just keeps getting broader and broader. And, whether there's any risks we are not willing to socialize, I think it's really anyone's guess. So again, I think the congruence principle that we must regulate different institutions and different risks in congruent or identical manner, maybe it's really worthy of discussion given this expanded central banking remit and expansion of safety net across board. And finally, to just propose some ways in which I think Andrew and Dan's congruence principle could be implemented, I have some thoughts on that they might consider for their future drafts. That we have to think hard about the political economy considerations. As I said, regulating by function rather than form keeps coming up. It just doesn't get as much traction and sustainably in the financial sector reforms. And it does beg the question of why we haven't embraced this concept before more wholeheartedly in the regulatory space. Why do we keep fighting the last wars and then assessing our performance based on that rather than taking a system-wide approach? Of course, I don't have a proof, but my conjecture is that this is because of a short-term trade-off in growth and employment versus financial stability. And even if there isn't a long-term trade-off, which is that if we really ran a stable financial system, it would probably be for long-term growth and employment. It would be a plus for that. But given that these trade-offs are often short-term, not just in political minds, but perhaps also in individual central bankers' minds, it's good to think about the implementation. And a second point here is related to political economy, which is that perhaps individually regulators may not have wanted to embrace this idea because maybe a central bank doesn't want to get into housing regulation, because if it does, they know it's going to be politicized anyways. And then, they worry it's a slippery slope. And then, first comes housing, then comes corporate loans, then comes monetary policy. And that, we could be having conversations about all of them all the time with the governments. So this suggests that maybe when we think about implementing the congruence principle, we may have to not perhaps take a case-by-case approach, even though it is good to think about every individual case, in my view, which is that I think the empowerment of the regulatory authorities has to be broad. And I think this goes to Andrew and Dan's point that we need legal backing for this. Because I think if we try to push for legal authority case by case, I think it's going to be a process that's politically extremely vulnerable and heavily subject to the risk of lobbying and so on. So I had three ideas. One is that perhaps we need to get in the US FSOC and internationally the Financial Stability Board /BIS to adopt the principle. Maybe the idea of regulating by function rather than form, or the congruence principle, should really be elevated at the highest level in these discussions. Maybe it needs a committee to be set up to assess it, to see how we do it across board and embrace it wholeheartedly. Second, and this is my favorite one, which is that we need to immediately put in place what I call as a Hotel California approach to extending the safety net, which is that once a part of shadow banking has been given safety nets because exposed they turned out to be systemically important, that's it. They are systemically important financial institution or a set of institutions from then on. And the SIFI authority, such as the FSOC, has to automatically be transferred the powers to regulate it. I found it really bizarre that we extended the safety net to money market funds, and then we were going through this lobbying process of whether we should regulate money market funds or not. I thought it was extraordinary after the global financial crisis. And if the global financial crisis cannot swing the pendulum decisively in favor, and we have to wait for long for these reforms to take place, it suggests that we have not embraced these principles, and the legal backing is not as strong as we would like. And finally, I think that even when regulators don't yet recognize a set of institutions as systemically important, they must run stress tests over there. So it's kind of like I would say a medium tier authority, which is that I can run stress tests on you, even though I'm not yet regulating you as a SIFI. Maybe we did this for insurance companies, for example, but perhaps it needs to be broader. Why? Because if they do show up as important in the stress tests, then perhaps we can think of applying the congruence principle, at least on a state contingent basis, provided there's the legal backing to do that. So if something is very small, it doesn't show up in the stress tests, maybe we don't need to spend a lot of time all the time trying to fix everything to the congruence principle, but we need to keep watching on an ongoing basis, testing what needs to be brought into the framework of the congruence principle, and system-wide stress tests are perhaps the only way to get this done. So let me stop there. I think it's a very important idea. I commend Andrew and Dan for bringing it up. I think it's just the right time, given how we have expanded the safety net worldwide over the last year. And I think we run the risk that even what we thought was entirely private risks, such as corporate loans and corporate bonds, may very soon become systemically difficult because risks are perceived as being entirely socialized. Thank you.
Thank you, Viral. That was really helpful. The second discussant is Hyun Shin.
Yes, hi, Jan. Thank you for the invitation. And let me just post my slides. I hope you can see that.
Yeah.
It's really a great pleasure to discuss this paper and to be back at Brookings. I think my discussion is going to be very complementary to what Viral has just presented, and it's really only just one message. I just want to underline one very important theme in the paper, which is that focusing on defaults may give us an incomplete picture of systemic risk. Now, this picture is typically how we think about systemic risk, and it's the so-called domino model of cascading defaults, where A has borrowed from B and B has borrowed from C. A takes a hit. If the hit's big enough, B takes a hit. And if that's big enough, then C takes a hit, and so on. It turns out that, so if this is true, then if the underlying assets are safe, then we shouldn't have systemic risk. But in fact, I think what the paper does very well is point out that it's the deleveraging that could be the really potent force here. And let me just pause here just to illustrate how you could have a change in leverage through three different ways. The left panel is the standard MBA textbook example of an equity buyback with a debt issuance. So you squeeze equity, you increase debt. The second is an asset sale, and then that is paid out as a dividend. But it's a third mode of increasing leverage, which I think is crucial to understand this paper, which is the idea that when the constraint on leverage is the margin or the haircut, then a decrease in the margin allows you to expand the total size of the balance sheet. And we know that this is the appropriate way of thinking about leverage in the non-bank financial intermediary sector. And if we just look at the data, this is from the US broker-dealer sector quarterly series from the flow of funds. And the way to read this is the horizontal axis is the quarterly change in the total assets of the whole sector. So it's the dollar value. And on the vertical axis, we're measuring the dollar value of the change in the debt, which is the blue dots, and the dollar value of the change in the equity, which is which are the red dots here. And if you look at the slope of the blue line is essentially 1, which is to say, dollar for dollar, a change in the assets are matched by a change in the debt, and the equity is pretty fixed. So we're looking at the right-hand diagram here, where a dollar increase in assets is exactly matched by a dollar increase in debt. Now, why is this important? Well, and just to point out that on the far left corner there is 2008 Q4, that huge deleveraging that we saw from Q3 2008 to Q4 2008. This was really the and if you read the example of the lead up to the GFC, it was a deleveraging and the increase in the margin which really caused the biggest damage. The issue is that if you have an increase in margin, like you saw in 2008 Q4, after a very protracted period of thin margins, this is going to really enforce the lower leverage across the system. And to the extent that that's actually going to other system participants, you're going to see a huge contraction of credit to these other parties. And so clearly insolvencies are going to exacerbate the stress, but it's not necessary to actually have the stress in the first place. And I think one of the things that comes up very clearly is that pecuniary externality, in other words, spillovers that work through prices, might actually be pretty important. And here's one example in the treasury market. The blue, so this is the difference in the futures implied price of treasuries. The blue is a 30-year treasury, the red is the 10-year. So it's the difference between the futures implied price and the cheapest to deliver cash bond. And then you adjust it for carry, and you saw this huge spike where, if you're engaged in a relative value trade where you're buying the cash bonds, financed with repos, but then you're hedging that price risk by shorting the futures, this kind of blowout in the spread is exactly what's going to force you to unwind, or this kind of stress would actually transmit to the other parts of the system. I think it's the so to the extent that this kind of price-mediated stress might be an issue, I think we need to have a better sense of why it is that we actually regulate margins. It's not so to some extent it's there to protect the equity and to protect against default. But from a system perspective, it's the size of the balance sheet which is also going to be important. And I'll finish with this one chart, which I think illustrates very nicely the central theme in the paper, which is that there's been a very far-reaching change in the structure of the market-based intermediation system. And the left-hand panel here is just showing you the total assets of three sectors. The red is the household sector, the blue is the non-financial corporate sector, and everything is based to 100 in Q1 1990. The yellow is the broker-dealer sector, which saw this tremendous growth in the lead up to the GFC. And and then we saw this very sharp deleveraging during the crisis. And then and from then on, it's really been very subdued. And you see the leverage chart on the right-hand side. The leverage has come right down. But I think what the paper does very well is that this kind of chart gives a misleading impression of the total size of the non-bank financial intermediation activity, to the extent that a lot of the activity has migrated elsewhere. And I think so I think the central theme in the paper, is well worth thinking with these kinds of things in mind. So let me stop there, Jan.
Great, thank you, Hyun. That was also great discussion. We'll open it up to discussion from the floor before we go back to the authors and give them a chance to respond to the discussants. We have a hand up now from Don Cohn and some more coming up. So if you'd like to make a comment, please raise your hand in the participant list. So Don, why don't you go ahead?
All right, can you hear me now?
Yeah, we can hear you, thanks.
I'm sorry. So I really liked the paper. I thought they did a very good job of defining the central problem of the risk moving away from the banking system and the regulatory arbitrage and the financial stability risk, the concept of the congruous, the linking up the regulation to get the same kind of leverage across transactions is right, coordinating across agencies. And I thought it was very clever that they found some existing authority that could be used in a more proactive way than it has been used. My question and my doubt is whether the agencies will really buy into this. So thinking back to the resistance to what seemed like pretty simple money market reform 5 years ago, I think it's going to be very, very hard to get this coordination. And I have one legislative suggestion that I think will really help implement, and that is give every agency on FSOC a financial stability mandate to add to their existing mandates and make them create a financial stability office that then has to interact with all the rulemaking and can interact with the other offices. I think until the agencies see the financial stability mandate, I'm doubtful, unfortunately, that they'll take the kind of actions that you guys have pointed out. Thank you.
Thanks. The next question is from Austin Goolsby. Austin, you'll need to, you unmuted, great.
Thanks. Kind of in the spirit of Don's previous question, doesn't the existence of the shadow banking system and their political strength, doesn't it say that though this is deeply correct as a diagnosis, that there would be legislative / political that the political figures would opt to block any such? It's not just the agencies, it's that senators and advocates of the industries would kind of work to prevent it. And I guess that leads me to my direct question of, is there a way to quantify in your mind how much more damaging it is to just have the Fed have to do emergency rescues or interventions of the form that we saw when things go wrong, rather than try to overturn the politics of the regulatory system?
So why don't you guys start off by answering those questions, and because there's been a number of issues raised about actual implementation. So Don's question is about that, and also Austin's, and it came up in the discussion. So why don't you start with that before we get any more questions?
All right, Andrew, you want me to start with the political economy points? In the absence of a negative from Andrew.
Oh, yes, sorry, I was muted.
Okay. In the absence of a negative, I will do so. Obviously, both Don and Austin are right in anticipating institutional difficulties in the interagency process and at least potentially political difficulties. I would say, Don, I think that, well, I'd say two things. First, speaking strictly as a lawyer, as a law professor, I kind of think that there's a financial stability mandate to the market regulators already within Dodd-Frank, even though it doesn't state it in just those terms. But given the number of rulemakings that it makes the market regulators involved in, I wish they would have concluded that they have such a mandate. If you could get legislation on such a mandate, that would be great. Anything more to push people in that direction would be great. My pretty strong suspicion is that President Biden's appointees to all of the financial regulatory agencies are going to have more of an inclination to undertake this sort of thing than certainly their immediate predecessors and maybe even the appointees of the Obama administration. But we'll just have to wait and see. Austin, on the point about quantification of, well, I'll leave that to Andrew, the quantifying question. I would just give you a kind of qualitative answer to that. If it turns out that this is basically going to be a free ride for non-bank financial intermediaries because there's not going to be a prospect of regulating, and as Vero pointed out in his comments, the safety net has become more and more explicit with each passing crisis, then I would anticipate that there would just be an accelerated outmigration of various forms of financial activity from the prudentially regulated sector, which I think that's going to make it hard to calculate, what that curve would look like over time. But it also is going to start eroding more dramatically the franchise value of the existing prudentially regulated sector. And so I think you kind of just get into a syndrome at that point. Both of your questions are very fair ones, but I would say that's the reason why Andrew and I took the position that we did, that we know what we're proposing is both kind of messy in interagency terms and not at all assured of success, but we're not at all sure what the better alternative is right at this point. I like some of Viral's suggestions because they're ways of kind of underscoring everybody's responsibility, even short of Don's legislative approach. But, when it comes right down to it, if Treasury and the Fed, much less the other agencies, are not willing to undertake this, then we are just going to be in the position that we're in. And by default, the Fed will have to, every time there's a market dislocation, it will have to decide whether, yes, we're going to go in and provide more liquidity again, even though we know we will have just reinforced every instinct in the markets that they can count on us under stress.
Andrew, did you want to pick up the quantification question? No? Okay. So I was going to ask you actually to respond to Viral specific suggestions, which Dan just mentioned. So in particular, you have implicitly maybe talked about the FSOC and the FSB a little bit, but you could expand on that if you want. But in specifically his Hotel California suggestion, which for those of you who aren't steeped in rock lyrics from, I'd like to think it's the 80s, but I think it's the 70s. You can check out anytime you like, but you can never leave, something like that. And the system-wide stress test, which I think has the flavor of an extensive margin aspect to the stress test rather than just looking at particular institutions. So could you comment on those other institutional mechanisms?
Sure. So with respect to Hotel, and you're right, Jan, it was an Eagles song from the 70s, not from the 80s.
Darn.
And of course, it was incorporated into Dodd-Frank, not with respect to liquidity assistance from the Fed, but basically it was the injection of capital by Treasury, so that today, for example, Morgan Stanley, even if Morgan Stanley or Goldman Sachs divested their banks, their IDI, their insured depository institutions, and thus ceased to be bank holding companies, they are nonetheless regulated by the Fed because of the Hotel California provision. As a principle for incorporating into legislation, some future legislation, I would be very much in favor of it. And, I think tomorrow, is the 13th anniversary of then candidate Obama's Cooper Union speech, in which he proposed something of that sort. Any entity that ended up getting assistance from the Fed during a financial crisis should, by definition, then be a prudentially regulated entity. I guess part of the problem here may be that a lot of what the Fed did was to inject liquidity into markets rather than necessarily to particular institutions. And the second point, of course, is that at least under current law, there's no automaticity there, and thus you would need, as we needed the SEC to take action on money market funds, you would need the regulatory agency or agencies with authority to act. System-wide stress testing, I think is a really good idea. It's not easy to accomplish bureaucratically, particularly in the US with our balkanized regulatory system. I think it's something that is probably easier to do in the UK. Don probably does have better insight into that than I, with a more unified regulatory approach. But I think as a policy and an analytic matter, it's sort of unimpeachably a good idea. And FSOC, yeah, I think, sure. I mean, I would absolutely hope that the theme would be struck and restruck in FSOC. And in a way, what we were proposing with this notion that Treasury take leadership on the Treasury-backed repo is that it be used as leverage to enhance Treasury's position within the FSOC for saying we can not only urge you to do something, we have the legal authority to drive it.
Jan, could I add a little something? Yes. So the theme that's come through in a lot of the discussion comments and in Don's point and Austin's point that has to do with the practicality of all of this. And I want to stress, Dan talked about these things, and I want to stress it just to make sure it's clear. Maybe a fundamental part of our paper was we know legislation in this area is hard, if not impossible. And so the task we set for ourselves was to think about what can we do with existing statutory authority? What is available with existing statutory authority that can't just be easily blocked by one filibustering senator, for example? And it was that with that theme that we ended up with this concept of congruence. Viral points out correctly that people talk often about regulating by function rather than form. Congruence is a bit different than that, because to really regulate by function, not form, you would need legislation. We can all kind of talk about this all we want, but that would be a paradigm shift in the United States to really do it right. Rather, what we're saying is we have existing authority already. It's just that places that have it need to think about it as a systemic risk thing. Right? So the SEC needs to think about their margining authority, not about protecting investors, but rather being congruent to the financial stability concerns that perhaps the bank regulators have when they do it for banks. So that's what all of this is what makes congruence a bit different than form and function, and makes congruence something that we think of it as achievable under current statutory authority. That doesn't mean the agencies are all going to behave themselves and want to do it. We're just hopeful that maybe right now would be, if it was ever going to happen, it would be now.
There was a question in the Q&A from Andy Atkinson. Andy, do you want to ask your question live? Are you there?
I don't think he's there anymore. Oh, wait, hold on.
Oh, Andy needs to be promoted to the Q&A.
Okay.
There he is. Thank you.
Okay, thank you. So this is really motivated by the picture Hyun Shin showed about broker-dealer balance sheets. I had an opportunity to ask Larry Fink about why did Wall Street get so big? And he answered immediately, ERISA. And it took me about a year to figure out what he meant. But I think it links back to our first session that the funding of defined benefit pension funds that was required under ERISA created big pools of institutional money. And as we discussed in the first session, if taxpayers are going to bail out these pension funds if they go bad, it seems like they are like a root cause of the demand for risk-taking in the financial system that the broker-dealers are servicing, through the hedge funds, et cetera. And so I just wonder whether it might make sense to go at that source. And it's not just the US, it's a worldwide demand from these funds to regulate them as investors rather than regulating the intermediaries.
It's an interesting question. I don't think that the pension funds have historically been a big part of the problem that we're talking about here. That's not to say they couldn't be part of the solution. And in part that really is.
I think they are indirectly through hedge funds.
Okay, so I see. So the hypothesis would be pension fund investments, for example, in relative value hedge funds. And then it's the relative value hedge funds playing this game of intermediating the treasury markets. And if we had It's an interesting thought. I can't say that I have thought deeply enough about it to have a good answer for you, but I will think about it going forward.
Yeah, I would just say, I mean, it is an interesting thought, but I would say that in keeping with our sort of ex ante comprehensive, don't wait for the mutation to occur approach, I think I at least would be a little reluctant to say, well, let's try to identify today's source of the motivation for a lot of these things, because that motivation may shift to a completely different source or a different channel tomorrow. So it might be something that, you know, the new Secretary Walsh wants to think about for different reasons. But in terms of financial stability regulation, I think one wants to stay with the sources of financial risk, and that's why we took the approach that we did. I will say though, Andy, that one thing we just mentioned very briefly in this paper, but you know, maybe there'll be a subsequent paper on this, is the specific role of mutual funds, potentially EFTs, other intermediaries that do not take on any risk themselves, but are basically just maturity transformers. But the scope of their maturity transformation has grown exponentially since the global financial crisis. And it probably does need some direct attention because of the differing incentives that exist for investors to pull out and the like there. But we just didn't tackle that in this paper.
Yeah. Could I just jump in with a quick comment?
Yeah, go ahead.
Yeah, if it's okay. Yeah, I just wanted to make sort of one slightly tangential point to Andy's observation, which is that while it's entirely possible, I think, that some of the pension fund search for yield is manifesting itself through hedge funds, etc., maybe even for other institutional investors. In the end, though, it really begs the question of whether they are being offered enough on their long-term investments of the traditional type, you know, what they used to earn through fixed income investments. And I think it's an important financial stability angle to monetary policy, where, you know, we have used bringing down the long end of the yield curve tremendously in the hope that will actually create longer term investments. But I think the question is whether it's creating longer term value enhancing investments, or is it really creating longer term high risk speculative kind of hedge fund investment? So I just worry a little bit that if the root cause of the problem is that the long end is in the fixed income, the traditional safe asset is not giving pension funds enough. If we try to attack that problem through financial regulation, we'll just have a whack-a-mole problem. You know, it's just going to show up in some other form. And, you know, then I just thought I'll raise this possibility that it's more about monetary policy, especially unconventional, rather than about financial regulation.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.